If you go back to 2023-24, you probably would see it was more liquidity and less fundamental. I mean, especially 2024. 2024, when 23 the slowdown started, and 24 it was exactly it kind of it started. There were a lot of disruptions and there was liquidity crunch and things like that in the economy. The economy was really not doing well. So a lot of the stocks which did well, markets which did well last year, were probably more because of liquidity and more because of money chasing very high growth sectors last year. I'm talking about last year, and that is the reason why it was not completely based on fundamentals. This time, I think it's more balanced in the sense that there is liquidity, as much liquidity as it was probably there last year. And I'm not talking about general liquidity in terms of flows, because obviously you have there have been so many IPOs, promoters selling, the P's selling their stake. So there were a lot of offers in the market and a lot of supply. So in that sense, a lot of liquidity should get sucked out from the system. I'm talking about the flows. But the liquidity has actually been created, has been more fundamental based, where the RBI itself has actually done these OMOs and created liquidity and basically tried to prop up the economy in general. So that actually that's obviously more fundamental in nature. So that is the reason why I said it's a combination of both market liquidity and fundamental driven liquidity drivers, whatever you want to call it. Business, and basically for business fundamentals and market liquidity.